Well, the first thing that I wanted to start out by saying um, is I sent an email to someone that just joined this webinar course um, recently, and obviously they were expecting 7 webinars with 5 more to come to complete the series of 12. And so far they got 18 links. And then they were told that there's still 5 to come, which I think quite shocked them. The response I got was, "What the fuck?" Um, anyway, you guys know that this has gone on for quite a while. There will be more sessions that are not part of the numbered sessions, and tonight is looking like it's going to be like that as well. There is a reason that I am doing this, and the reason that I'm doing this is because when I get feedback from people that have done webinar courses before, like module 1 and module 2, I find that a lot of the time they are making mistakes in the trades they take. They're taking, for example, swing failures I wouldn't, or they're taking levels trades that I wouldn't take. And obviously that shows to me that it's going to be hard for me to convey all the pertinent points, because there's so many nuances to a strategy. So you can say the basics, I look for this, I look for that, but you can't cover every possible occurrence. And there are times when I will decide to do things, I will make a discretionary decision, and it will confuse people. And of course, what I'm trying to do on this series of webinars is build in a lot more material, and every time something happens to me that I think is interesting, try and talk about that, so you get a huge number of examples, even though I suppose it is a bit more laborious to go through it. I can send you all of those 18 links. Yes, Brian, I can send them in order. Can you just drop me a mail requesting it? And the same goes to anyone in the room now or listening to me. If you want all 18 sessions in order, just drop me an email and I'll send you them. It will probably be a lot easier to watch them back to back like that. Tonight what I want to do is we're talking about trade management, because that's the topic that we're on. But rather than just give you a lesson on it and exactly what I do, I want to start out by talking about the last 3 trades that I've done across 2 days. And the reason I want to do this is because they were interesting trades. The first one I made 16 ticks on, but I could have made an awful lot more, so it's important to talk about that from a trade management perspective. And 2 trades today, you probably saw on Twitter what happened. I ended up with 2 scratches, even though I nailed the turn virtually perfectly. So, one thing you'll understand is how good your entries can be, but as I said so many times, entries are not as important as the trade management, and certainly for me today there were problems with the trade management, but I want to explain why that was so that you can learn from what happened to me. But first off, I want to take you back to yesterday, so to Wednesday the 13th, and talk about really what was the optimal trade setup. And I'm hoping if any of you guys are trading bunds, you took this one, which was the long at 17s. Okay, if you did not get long anywhere around 18s, 17s area, then you've done something wrong. Okay, so a few people are saying they got 18s. Good work. That was a very, very good trade, and you had to be looking for that area. I did send this little tweet out, which hopefully everyone saw. If we see 17s tomorrow, I'll go balls deep. Then take a loan out and go balls deep with that too. That was basically how confident I was in that level. Let's just talk very quickly about why, with the concepts that you've learned in the course so far. First off, you can see here that we had a coil of sorts going on in the bund. It was coiling up. We broke out of the coil. We retested the coil from above, and obviously we had prior resistance there, so it was an area to look for longs. Actually, we bounced very nicely there. Then we undid that bounce, and at first when we undid that bounce at the early part of this week on Monday, I was somewhat bemused, because I actually thought that we would lift off from this inside day that we got here, and we would push higher, and that would be the springboard for a test of the liquidity pool, beyond the highs. In actual fact, like I say, we get the inside day, And I thought to myself, well, this will be interesting. We're coming back for another test of this area. Let's see what happens. And of course, we get our infamous ID failure, inside day failure. And when that occurs, you know, with a high degree of probability that we are going to take the other side of the ID. And beyond that, you could start thinking about this area getting tagged, but essentially the high of that ID was 80s. You've got to be looking at 81s to be tagged. Now, just a quick question on that that I got was, do you go for the high of the inside day that failed, which would be that high there, or do you go for the original inside day? Because there were two inside days back to back. And the answer is I go for the latter one, the one that actually failed. Now, obviously, those are pretty close together. You could have gone a little bit further, but I will usually offer out at the first high. If they're pretty close like that, it doesn't really make a whole lot of difference, but that is simply what I do. So that's what the daily bias was looking like, and really you had to be hunting an area to get long. So where was the pertinent areas to get long? Obviously, the day in question closed here on the charts, so you start looking below market for potential levels. And what do we have in terms of our 5-minute structure, our naked levels? We have this here, okay, and we have really this here. Okay, note that this level, I know a few people got caught out by this. They were looking at this level down here, and people were bid 6s and 9s. Okay, and if you're doing that based on something that you've learned away from me, that's absolutely fine. But if you're doing that based on my strategy, already you're doing something wrong, because if you're buying 9s, you're buying prior support. Remember, I don't buy prior support, I buy prior resistance. So again, it's going to put you long here, or it's going to put you long there. And the question is, which one of those are you going to be looking to get long at? The clues are in the confluence areas. So if you take a fib from low all the way up to high, you can see that you've got the 38% fib, just a bit lower than that first high at 33s, and you've got the 50% fib down here at this area, okay, just coming in on those 18s. The other then key consideration to think about is the market profile. And obviously, if you take a look at the profile, what you are going to see as clear as day is that we had the prior day's volume value area high. Again, the most important area to look out for. That was actually coming in a little bit lower at 12s, but it was pretty key. The other thing that you're going to note is just above that, you've got the LVN before the volume starts to thicken out a little bit there. So that last LVN is at 18s with the volume value area high at 12s. It makes it a very, very important area to be wary of. To my mind, those two things, combined, made the 17s, 18s a more interesting area. Not to mention, and this is the other important part, that you could see that down there, and I'm not saying the 35s is a bad level, but you could see that down there we would have the potential inverse head and shoulders. If it comes down here, you've got left shoulder support in that area there. It'd be a lovely area to see it carve out a right shoulder and then go vertical. So again, I'm not saying the 35s was too bad a level if you trade it, but I am super picky, and the reward was there from the 18s as well, because there was nothing really in your way. You had a free run if you get long here, whereas if you get long there, even with the daily bias, you could run into problems here. Look to the left, here, here, here. All of these are issues. So I got long at 17s, and the stop went below the thrust candle, so the stop was at 8s, and it was by all means a pretty clear-cut move, although obviously you can see that it had a bit of a bounce, then a squeeze lower, and then just as low as that 12s, and then ramped. Obviously that volume value area high is waiting down at 12s, so you don't want to be nervous. I am as aware as anyone that when you get in a trade and it puts in a bearish engulfing, there is that momentary feeling where you think, oh shit, I'm going to get stopped here, but you just have to trust in the level. And I don't manage trades based on 5-minute candles like this. If the level is very good, then I'm going to leave it. Sometimes I'm going to nail it absolutely perfectly like I did today. Other times it is going to squeeze me offside, like in this case it's going to put me, a few ticks offside. That's just the way it is. But certainly a close through a 5-minute level like that is not going to get me out of a trade. At that point I'm going to have faith in my level. Now, here is where it comes down to one of the real big, I suppose, dichotomies of trade management. When you have a big daily bias like this, do you, number one, take the trade, put a stop and target in, and just leave the room? Or do you, number two, actively manage that trade, and either that means trailing your stop up and trying to hold, or alternatively taking profits, trying to re-enter the market? There are pros and cons of both ways. The first thing I would say is, when it comes to walking away, I know a lot of professionals that do it, and I'm sure I've told you this before, people that I've worked with in prop, huge traders, often the guys that are trading the biggest size as well, will literally lump into a position like this and just fuck off. It's as simple as it gets. And the reason that they are able to implement that kind of leap of faith approach is that they obviously will have, looking through their journal, seen that it is statistically valid for them to do that. They'll know that their target will get hit before their stop on the majority of trades, and they're simply able to implement that. The one thing to note with that is that obviously, it does hurt real bad if that doesn't work. So even if over the long run there's an edge in doing it, it hurts real bad on those times that you don't get it right, and you've got to be careful that it doesn't affect your psychology, because if you're going to walk away, you might find when you come back later on in the day that you've been up 30 ticks, which at decent size is a huge profit, only to see it come all the way back on you and you've taken a loss, or you end up forcing out for a scratch or whatever. So that can be painful, and certain people, even if there's an edge in doing that, will not like that style. You've got to find something that you're comfortable with. I do prefer to actively manage, but again, when it comes to actively management, there's the trailing approach, or there is the getting out of the market and then getting back into it. And again, the advantages and disadvantages of both are as follows. The advantages of just trailing are that when you get a straight line move, and we had one more or less here in the Bunds. I mean, nothing's ever straight line, but this is about as straight line as the Bunds are going to get you to target. If you get a straight line move like that, then it's fairly easy to trail and stay in for the entire thing. But the problem is that the market rarely, I find, will get to a target, especially a daily target, that could be substantially far away, without a wobble. And it's these wobbles that will see you maybe go from plus 50 to plus 15 or plus 20 if you've trailed too aggressively. So what I prefer to do is get out and get back in. But the disadvantage of doing that is, although you will often get opportunities to get back in, two things can happen. One, it might just ramp and you don't get the chance to get back in, or two, you might do what I did in this particular trade, which is have the opportunity to get back in but not take it. And it's always a bit frustrating when that happens. But from a management perspective, let me show you what I actually did here. On the way up, I was looking at this level at 40s here. So we've got into profit at the 18s. It's starting to move up, and I'm well aware that the first level on the upside is going to be right here at the 40s. Okay, and that's the area that I'm watching very, very closely. And what I decided to do there is take profit a tick beyond that high, so get out at 41s, okay, into that support resistance zone, and then wait and see. And if we broke through 41s, I was simply going to come in and rebuy it, because I know the majority of the time the Bunds is going to pull back and it's going to test that area. So what actually happened up there on the move through 41s? It got up there pretty quickly, and at this point I did not trail my stop, so I sat in the 18s position all the way up to 33s. saw it pull back to 21s, and then it started to take off. Now, the first time that I moved my stop on this trade, okay, because you've got to expect a bit of back and fill in the bunds, was on this candle there. When that candle formed, I moved my stop from where it was underneath here, which is where I put it at the trade implementation, to there, underneath that low. And the reason I moved it from there to there is at that point we had carved out an inverse head and shoulders, and we had now moved up, closed above on the 5 minute above the interim high. So at that point I figured that the market should not be up there. Okay, but it's an important point that you don't want to trail the stop too quickly, because if you trail it too quickly you will get caught out. Bund loves, and I've seen this many times, to ramp 10 ticks in your favor and then come straight back on you, and you're going to see it's done that to me twice today, and it really loves to do it, this market. So you've really got to know what to expect. Either you've got to sit on your hands with the stop and let it go, or you're maybe going to find a way to literally grab the first 10 ticks and rebuy it back. But I don't want to dwell on that, because that's not what I do. So I'll give it a free rein for the first initial move. But anyway, that's the first stop placement. So the stop placement has been moved here to point number 1, and I'm going offered to get out of this at 41s. Now you'll notice 41s trades, but the problem is that 41s doesn't trade out. 10 lift the offer at the high. So I'm going to pull the footprint onto the chart here, and you will see what it looks like. And if I just move this across a little bit here, there is a few things to note. First off, as it breaks the high here, there's the 10 that transact at the high, so I'm not filled on the offer. The other thing to note is the delta divergence coming up into that area. Okay, so if we move back here, you will see, have a look at this candle here as we start to ramp. We've got a delta of 929. We continue to push higher on that candle there. The delta drops to 524. We continue to push higher there. The delta drops to 371. Okay, so we're moving up on a lower delta. We spike the highs. No one trades through that high, but we do get these institutional buy block 363 lifting right on the high, and that was very worrying to me. And because I'd planned to get out of the position there, and I see this fake out, I immediately end up scrambling, you know, for an exit. And mid that candle, as I seen I'm not filled at 41s, I'm trying to get out. I remember trying to pay down at 37s. I didn't get filled. I ended up just getting out, hitting market at 33s. So I had taken 16 ticks. So that was the way that I had traded that. And again, pretty typical for me. Even though I've got the bigger target of 81s, I'll get out and look to rebuy. Now, the fact of the matter is, look at this retest that occurred, and when you look at that you think, okay, brilliant, so there's the second entry. But unfortunately I didn't get that second entry, and this is where I made a mistake. And this is where sometimes, unless you do adopt that principle of either just trailing or stepping away and leaving the trade, you are going to miss things. On the hourly time frames, as we are moving up there, we create a hammer, okay, at this point here, and we lift off through the hammer, and we get this nice substantial move up that you can see down here. Now, what I was anticipating is what so often happens, which is a return to the hammer high. Hopefully you get that. Incidentally, and I know we're going off topic here, but exactly the same thing in the DAX today, Ledges. I don't know if any of you guys got this, but check this out. Swing failure on the 60-minute chart. Look at this hammer here. Off we go. Impulse move straight back to the head. Everybody fucked for break even. Look at this parabolic rally. Okay, time and time again you are going to see the same thing until you rely on it. And sod's law, the minute you do what I do, which is go, right, that's coming back to 35s, the bund doesn't pull back. But I was looking at 35s and I thought, well, you know what, let's not pay up 41s. It's probably going to come back to 35s. We can, you know, get the market a little bit lower. As it is, the retest of 41s, which is also the initial balance high of this day in question. You see it here, ends up being the pullback low, and off we go. So I have missed that second entry into the trade, and at that point it becomes quite hard to get involved. There weren't many profile levels, and it pretty much went vertical to the actual target there. The only other potential trade that you could have got on at that point, as far as I was concerned, was buying it here, but it didn't pull back there to get you involved at that prior high, and then it kind of chopped around here, and by the time that it broke lower here, I wasn't completely convinced anymore, but it was also in the dead time at 12.20. So it wasn't a bad trade. It was a 1.8R, it was 16 ticks. It's a winning result, but it is always a bit disappointing if you've got a much bigger bias. And so I wanted to mention this because, again, you've got to be on your toes, and if you're going to get out of a trade, you've got to make sure that you do get in. And there I was probably just being a little bit too picky. Even after I saw the price action here with this little hammer off the 41s, I still didn't get involved. And I suppose I should have been a little bit more aggressive in light of the fact that everything was looking good. The target was there on the daily, the hammer was there on the H1. And you probably know from other sessions that I've done with you guys that I do like to dwell on things that I've done badly, and you don't probably see, I suppose, many educators coming in and saying, right, well, let's look at the last 3 trades that I fucked up. But ultimately, this is how I believe that you learn, because it's not all, roses when you get involved in the market. There are going to be days where even professional traders are going to get thrown curveballs, and as I've said so many times, you're always acting only with the information that you've got in front of you at any one time, and sometimes the market pressures you into a decision which ends up being the wrong decision, but that's the way it goes from time to time. So let's move on to today. And today was real interesting. And this is where today went wrong for me and why it went wrong. So, first trade of the day. Who got the 08s? Hopefully, most people. It's pretty simple. The 08s was here, and I bought the exact tick low at 08s. Again, you could have got long there. I opted to just go a little bit further back, just like I did on the last trade, buying 17s rather than 18s. I've noticed Bund can just sometimes stretch a tick lately, but it wouldn't have made a huge amount of difference. It's a pretty straightforward trade. I know a few people on Twitter got the 08s, a few Bund traders I was talking to, but I don't know if anyone that's doing these modules got 08s, but it was very, very clear structure, and I think a fairly obvious place to have been looking and to have been thinking about a long. Obviously, there wasn't really anything, as far as I'm concerned, on the profile to have backed up that trade, but it was a pretty clear as day level. And also 8s was the VWAP. We get the lift off, and then we come straight back after moving away from it. So a very classic trade. Now the trade filled at 9.50 and bought the 08s, and immediately 10 ticks in profit, literally in about 2 or 3 minutes. But look what happened on the 60-minute chart. And here is our first problem. The 60-minute chart has ended up the hour, with me still in it, as that. And that is a nasty fucking candle to be caught long on, with a failed break of pretty much every single high of the bleeding range. Now it's come back down, and obviously you can see that tail emerging, but when I've got in, I've thought to myself, well, it doesn't necessarily mean it's going to close like that. If we can get a quick surge in the next 10 minutes, we might not close like that, but we did close like that. And as we closed like that and the market started to come back, I thought, you know what, I'm getting out of this trade, and I decided to scratch it. And I scratched it at the entry price I got in, only to see it immediately bounce higher. Now, I'm not saying I would have got a sizable winner out of this. What I'm saying is, though, is that I got out at the worst place. But I wanted to kind of make the case for the exit there, which is the fact that the H1 bias, was terrible. You don't want to be long with that kind of H1 bias. You know, a big break of those highs could have really seen a fast money liquidation. So scratching that trade, obviously on this particular trade example, was literally the worst thing I could have done, but nevertheless, scratching there and seeing it bounce was better than the alternative, which was the complete mug that you would feel like if that went to stop and you could see that H1 candle. Pete, your question, would you normally bounce off the VWAP or go through it? The VWAP is a fantastic tool, highly used in prop. You will be looking for bounces from the VWAP. In fact, I know traders that will literally have that almost as a systematic trade, the first bounce of the VWAP. So the first pullback to the VWAP, whether it be long or short. It's a very, very good trade. You want to look at it as basically dynamic SR. So it's a moving support resistance line throughout the day. If it lines up with significant SR on the chart, then it's time to get balls deep, basically. It is very good, the VWAP, very, very good. So with that at 08, you know, you're definitely long. So second trade of the day then occurs when we go sideways and the very level that I've bought at 08 that bounced so nicely gets taken out here with acceptance beneath, and I come in and end up selling it right there, looking for, at this point, a run to the downside. Now I've got to be honest, even with the swing failure at the high on the 60-minute charts, I wasn't outright bearish in this area here. And part of the reason I wasn't outright bearish, even with the day looking as it does today, I'm still not that bearish. I feel that what we're seeing in terms of rejection up here is just a natural part of the process, okay? There's resistance up here. It's very likely that sellers are going to come in when we get through there. Longs are going to dump because they're going to want to wait and see what happened. And obviously people will have seen the multiple, you know, touches of resistance come in and sell there. I think some rejection through there, whilst not guaranteed, is likely. And obviously we've seen that rejection, but it doesn't really make me outright bearish. And the reason it doesn't make me outright bearish is because we've been back here so many times that I personally think the chances are that we are going to probe higher. Now, obviously, you know, with today's rejection that we've got, it does set the stage for potentially lower prices. And so I think now, if we do take that high, there's going to be a fantastic trade because everybody is going to be caught if we take that high now, as far as I'm concerned. So, you know, you want to look for a good trade up there, but that's another story. I wasn't outright bearish, and that's probably why I made a relatively quick decision here. But when I got in this level, which again was a cracking level to the downside, and I've sold right there, immediately move about 8 to 9 ticks into profit and then come back. And it was on that candle there, as I'm being pushed offside now 2 or 3 ticks, that I made the second decision of the day to scratch. And honestly, I can't even remember the last time I scratched a trade, and I've scratched a trade twice in one day. And the funny thing is, I'm often on Periscope and I'm on webinars saying, guys, don't fucking scratch trades, it's the worst thing you can do. And then here I am doing it. But again, there was dynamics that at play here that were changing the situation a little bit. Number one was that I wasn't outright bearish. So when we've come down, broken a level, found defense at the prior low and then ramped up, it is making me second guess myself. And I've often said, if you are trading against the bias, it makes the management a little bit harder. Just like here, when you get long, you're going to immediately lose confidence in the long if you see a big 60-minute signal to potentially short. So here, when it took me back offside, I ended up scratching the trade. But the other thing was, it was coming into news, and that is a very important point because it's the 10 past 1 when I scratched that. There were 20 minutes to go, and as you can see, it collapsed over the next 20 minutes. But plenty of times I've been in a boon trade with 20 minutes to go, and it will absolutely do nothing, and then I'll be forced to take that event risk, which is just not something I'm prepared to do. So really there, again, I had to make a decision to get out. But what you guys want to be doing, and not particularly over a couple of trades like this, but what you want to be doing in general, certainly what I do and what I will continue to do, is I will always note down trades like the first one. What eventually happened to it? I note down that it would have hit the target before it hit my stop. Okay, from buying the 17s, it would have gone to 81s. That's nearly a 7R trade, and it would have done that, okay? With these two trades, both of them would have had decent maximum favourable excursions. The first one here might not have got to where I'd have got out up here, but the second one, without a doubt, would have taken me to a profit objective real quick underneath these lows. So, again, I'm going to journal that. I'm going to use Edgewonk. I'm going to write into Edgewonk that, this is the outcome of the trades, and that scratching the trades was a mismanagement here, but why I scratched them. And again, when I say mismanagement, I mean mismanagement in light of what happens. I don't actually believe that I mismanaged these because I made the best decision with what was in front of me at the time. It's just obviously when you see what happened after, you always look at it as a mistake. But you've got to always focus on the process. So, looking at the questions, Pete, your confidence has been shit the last week. You've dropped confidence. Well, why have you dropped confidence? Is it because the Bund was difficult in the first week? Because if it is, don't worry about it, because I'll tell you one thing, the first week I found very, very difficult. I actually spoke to some prop traders who said the first week was alright in the Bunds, and some people did well, but there'll always be someone that says they did well, but I found that it was very difficult. I literally couldn't hit a fucking barn door with a rocket launcher the first week back in Bunds. Every time I clicked the mouse it went wrong. So I realised that pretty quick and just ended up not hardly trading. In fact, I'll tell you what I had. A -5, a -9, a -8, -6, right? So at that point I'm like, fuck that, this is a difficult market, and I'm stepping out of the way. So yeah, it was hard. It's funny, I spoke to Brannigan Barrett, you probably know Brannigan from Futex, and he said that the first week is always difficult, and the market rarely respects levels. I've got to be honest, I didn't really agree with that, because I've always found the whole of January to be fantastic, but I've got to be honest, this year it did start shit. It did start shit, but that's the way it goes. So you're going into the DAX now, Pete? No one's going into the DAX. Get your ass back in these Bunds. Don't get into that DAX. What do you think this is? Yeah, well, as I say, that's really what I've done over the last few days. But I wanted to just to briefly talk about that. What I'm kind of hoping for tomorrow is a decent push up off the open and some strength to come into the market. I'd really like to see the bears on the back foot and forced to puke. I think there'll be a lot of bears after this move. And the first decent level is this one here, which is at 59.85s. We've got obviously the volume value area overlap that you can see on the profile here. So this volume value area high, this volume value area low at 90s. Ideally what I'd like to see is it take that area out. I'll probably come in and buy this 85s and look for a long. That'll probably be my first trade tomorrow. I think it's also probably worth having a go on the short side at double O's. This little reactionary point around here, so at the round number, it's worth seeing if we can get a longer term play from this big daily move. But basically I'd like to get long the 85s to the double O's and then try and see if the double O's will run. Yeah, I think you're right, NL. I think you're right. It's likely to range until it breaks and closes basically either above the 60.22s or down through the 59.09s. Yeah, I completely agree. It is prone to that, and that's why tomorrow could be a tricky session. Alright, ledges, well, I will see you all again shortly. Cheers, guys.